Stocks continued their pattern over the past week and a half, 2 weeks or so of just grinding moves, recently to the upside, but then the last few days to the downside, but just small trading ranges, small volumes. We'll take a look at the current decline that we've had over the past few days to see whether or not that actually kind of fits as a decline that starts a longer term pullback, or whether or not it's just giving back some of the gains that we've had since the election, especially since, again, the last couple of weeks where we just haven't been moving anywhere, both before and after the Thanksgiving holiday. Very grinding moves. Today you had the reemergence of that three-headed monster that puts pressure on equities from a risk appetite standpoint, so we'll talk about that. Some significant moves, especially in the dollar today. So we'll talk about what our expectations are for the dollar and especially for yields going forward because of their influence on what's going on in the markets. The U.S. market is kind of in a unique situation, and particularly the top three sectors, the biggest three sectors, are in a unique situation relative to the rest of this peer. So we'll break that down and see how that's impacting breadth and what that is telling us about the state of this current intermediate run that we're on, and how close we may be to the beginnings of an intermediate decline, a pullback. So we'll break all that down in today's video. We'll take a look at a stock in that technology sector. Again, a lot of weakness in the technology today. We'll take advantage of that with our trade idea. So let's go ahead and get started. Today is Tuesday, December 10th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live videos, where I take a look at old Market Outlook trades that we've done in previous videos to see whether we should stay in them or get out of them. Come down to the bottom. We also put on today's trade idea before the market closed during that. It's at 3:30 Eastern time. Click on this link here that will take you to that class. Come down to the bottom, click on this heart that's down there. It'll open up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Scroll down and hit that like button right there. Again, the more you do that, it helps get our content out to all of our followers on these two platforms. So thank you to those who do that day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's go ahead and start off taking a look at the S&P 500 with the market forecast indicators. You can see we ended up with a down day today. The near-term line broke 60 yesterday, right, with the momentum line way below it, right? So the day before, the near-term line was at 71. Yesterday it was at 41, so there's the first day dropping below 60. The momentum line was strongly oversold at the time. And then today, the near-term line followed the momentum line down into the reversal zone. And now you have a pretty deeply oversold near-term. Usually, again, when you get these kind of declines where the near-term line falls in the reversal zone, we end up with a bull tag, right? This one took a couple of days after you got the dip into the reversal zone. This one occurred on the day you dropped in the reversal zone, and this one we got the light pink shading just a couple days later. We're nowhere near a bull tag right now because we are nowhere near, it's not common to get this big of a near-term decline with the intermediate line above the 90th percentile. Usually the intermediate line's dropping pretty sharply when you're having this kind of a move. You can kind of see something similar happened over here. The intermediate line was above 90. We didn't drop and get the bull tag on that day, but we did after. The next near-term decline we did come really close, and then we really got it the next time. So while that might not set us up, this might not be like the bearish near-term decline that says, oh, here we are now, we're gonna start get dark pink shading and a red line. It does suggest that maybe the next, that one's coming, and that the next peak might not be as bullish as what we've seen. This was a really good bullish near-term run. As you can see, we got above the 90th percentile here. Got above the 80th percentile. We were in bullish territory for multiple weeks. That's great. That's a good, strong near-term rally. So might not get that kind of a near-term rally coming off of this decline that we're getting, and only 1.5% now up above the moving average there. Let's take a look at the NASDAQ 100, right, which is what's been driving a lot of this bullishness over the last couple weeks. And you can see it also is not as bearish, but both the momentum and the near-term line downs. Again, and technically this is an intermediate confirmation signals. Again, we saw this similar over here. We did drop. It did not get a bull tag because we were so bullish. So probably something similar to this type of move is what we can expect coming out of this, and we'll see if that ends up being the case. Again, because we were not nearly as bearish as we were on the S&P 500 on the NASDAQ 100. And hopefully that can lead the S&P 500 to its own own nice strong run there. The Dow's been a little bit more bearish. We've been in we dropped down on the momentum line last week. It's been down there this whole time for 4 days in a row now, and now your near-term line has been at extreme lows 2 days in a row. So much more significant decline on the Dow than what we're seeing on the S&P. The intermediate line's falling, the market sentiment's falling. They're both falling, but at least the intermediate line's still above market sentiment, still above the 80th percentile. So you don't have a bull tag yet, which again typically you get when you've got these bearish. We didn't get one over here. We got the light pink shading. We're not even the light pink shading yet. So that's the benefit of being as bullish as we were, is we can have this kind of weakness without necessarily producing these patterns. The Russell 2000 is a different story. We do have the light pink shading now. The intermediate line has crossed below the 80th percentile. It is very close to crossing below its own market sentiment line. The near-term line is very strongly oversold down to extreme lows. Again, we saw this before coming off the election. We're seeing it now. It's a little bit more subdued now. It's not as deep. It's over a longer period of time, but still you can see just as bearish now as we were here. So again, short-term sentiment bearish across the board. The question will be whether or not it's strong enough bearishness to halt the intermediate run, or have we seen this play out before and we'll just bounce off of this? It's again, considering how long we've been bullish on the S&P 500. It's probably more a reflection that we might be getting closer. It might not be at the end, like we weren't here, but it might be closer to the end, right? So again, something similar here, right? We might not be at the end, but we might be closer to the end with maybe only one or two more near-term rallies left on this current intermediate run. Let's take a look at the weekly chart. As you can see, the weekly candle, not surprising. We talked about this. We talked about that the size of the candle would drop below the purple line in the next week or two, and this is the week. So again, a lower high point. If the lower high is not the transition, it usually does lead to a transition candle. So again, that suggests we might have a transition candle coming next week if this is how we end up this week. If we don't end up getting it, now again, as long as the transition candle is not a big bearish candle, then we're good to go. And as of right now, that's the case right here. And if we end up with a transition next week, then it might not be that bearish of a candle. So we'll have to see how it plays out next week. But when you're in this convergence mode, you only get a week or two where the green line down here pops above the purple line, which means you have a pretty decent sized body. Then you're back to a lower high, right? And when you get a lower high, it either leads to a transition or it leads to or it either is a transition or it leads to a transition. If you take a look at the Russell 2000 and the Dow Jones, we do have the transition. We got the lower high last week on the Russell, and now we're getting the transition this week. And so far is a relatively bearish week. Not too strongly bearish, but relatively bearish week there. And then when you look at the Dow Jones Industrial Average, again, we did get a higher high, but now we are getting a small transition this week, but not one we're too concerned with yet because that's not that big of a of a bearish candle there. Looking at the three green arrow charts, you still have three green arrows, or you still have green arrows mostly. In this case, you only have two on the on the S&P. You have a red arrow on the MACD. You have three green arrows still on the Qs. That's been your stronger index lately. Your Dow only has the two green arrows. So you have the MACD with the red, and so say you have two reds on the Russell 2000, so it's a little bit more bearish, and getting closer to that third red arrow on the moving average. If you take a look at the two-line version for the S&P, you are still above the 8-day, or you're still above the 17-day, breaking the 8-day. You are in The MACD is below its moving average, so technically we're in convergence when your MACD is below its moving average and you're still above the 17-day, the second number right in the MACD. So you're still above that line. The stochastics is below its moving average too, but both are still above 80, so we're not too concerned about that one. Let's look at the oscillators here on the DMI. We are now below 30 on the positive indicator, and you can see the ADX appears to be peaking because, you know, the negative indicators really jumped up above 20 already. It's jumped up above 20. Remember, IWM's a little bit weaker. The ADX has been above 20 this whole time. The negative, excuse me. The positive is just barely crossed below 30, and looks like your ADX has peaked again there. Despite the fact that the ADX has gotten the 40 two times, your the positive indicator, excuse me, has gotten the 40 both times. Your ADX has gotten nowhere close to getting up there. Let's take a look at the RSI and the CCI. We are back below 60. Again, that just means we're not as bullish. We're still about in bullish levels. We're just not as, we're not trending. We're not at such bullish levels that we have a trending indicator here. Let's just move this here to today. We'll move this one also still to today. So they're still going strong. Again, remember the green box on the bottom doesn't turn not green until we drop below minus 100, and we're well above positive 100. So that's not even more close. And then the RSI doesn't turn red until you break 50, and then it has to be solidified with a break below 40. And it goes back, you know, to we started the coloring when it broke the 50 mark. So 50 is kind of that first sign, for kind of warning sign. And then we stop turning green when it's below 50. And then if it goes 40, we turn it red. And if it turns back above 60, then we're back to being green. Just like that. So we're still barely below 60. So it clearly still bullish, still on this bullish run. And then finally, if you look at the Ichimoku cloud, you can see the trend strength indicator. We are below the green line. So the trend strength is getting weaker. We are still intermediate strength trend because we're above the dotted lines, but we never did get to mature levels. And of course, when you look at IWM, you can see very mature levels. So even though we're below the green line, we're still well above the cloud. Still has a very strong positive rate of change, which won't be the case for much longer, but still very mature, bullish trending levels until you break that blue line. And that's not an issue yet as of right now. If you take a look at the Bollinger Bands and the Keltner channels, again, we are not in the upper quartile anymore. The bandwidth is relatively low. We are not above the upper Keltner channel either. At least we're in the upper half, so the momentum is starting to wane. Again, looking at IWM, you can see the bandwidth is still relatively high and falling, so the bands are still outside the Keltner channels. But we are flirting with the midpoint of the range now, and you're clearly losing momentum there. All right, let's take a look at today's intraday move. As you can see, 2 days in a row now we've closed below the prior day's low. Today we were flirting with it, and then by the end of the day ended up closing down. So small ranges, but still lower high and a lower low on both days. We are flirting with last week's low point. As of right now, with 3 days left to go in the week, we are still holding last week's low, but that's an important area to watch. IWM, which did close below the prior week's low on Friday, is also below this week's low. So we also, we did get a lower high and a lower low and close below yesterday's low, but we are closing below. And again, very top heavy with a big volume node up here, and not as much volume below the midpoint of the chart. So really important to kind of watch this stochastics indicator. Again, we're not close on the S&P to even getting out of bullish territory, but the Russell is out of bullish territory now and is close to dropping in the lower half of the chart, and that moving average is falling. So much weaker pattern there on that chart. I mentioned to you the ranges and the volumes still are very light. Today's range, even with that move at the end of the day, is still well below the average. The volume is still below, again, below very low averages too. If you take a look at the averages themselves, you can see the ATR is down to 4.5 points, which in and of itself isn't as significant as the fact that when you relate it to the price, so the normalized ATR is down below 0.75, we're at 0.73 right now. So extremely, getting below 0.8 is low, getting below 0.75 is extremely low, getting obviously even lower than that, and we get like the ranges are just really small. The volumes you can see is at 52-week lows. Already the average, is at 52-week lows. So the being below average in the volume is being below 52-week low averages. So very, very low averages, very low levels even today, considering that we're significantly below those averages there. If you look at the volatility finished last week at an extreme low. We're way below the 80th percentile, but we've been ramping up. Still at bullish levels, so we're still no concern, like bullish risk appetite levels. So still no really concern. We're still below 15. Your VVIX, however, is not below 90 anymore. It popped up on, what was this, yesterday? It popped up on yesterday up to, what was that, 93, from Friday's close at 87 to yesterday's close at 93, and then today up to above 94. So it didn't stay below 90 for very long. Remember, 90 is kind of the sweet spot. We want to get below that so it can trend to the upside, and we are not able to get below 90, and it's bouncing back up. Anything above 90 is usually it's like being above 15 or 20, even more so probably above 20 on the VIX. So that's getting to a point where we're too volatile, and tends to be coincident with bearishness in the markets, right? A risk aversion in the markets. If you take a look at where the VIX is relative to its average values over the last little bit, and you can see we are above its 8-day average after having been below it for multiple weeks, but still below the 17. So we're still okay. We're not necessarily there yet to where, when you get back above these longer term averages now, like we did over here in mid-July, that kind of led to the big pop in volatility that we had, in early August. And then ultimately led to volatility in late August, early September, and again in early October, and then again at the end of October, because we were above the 200-day moving average that entire time. So as of right now, we're still below the 200-day moving average, but you can see popping up a little bit. Hopefully we can do this kind of pop up where we just stop and then stay bearish on volatility, which means we stay bullish on the markets for another extended period of time here. All right, now let's take a look at what's driving this price action. So we'll take a look at our asset class comparison chart, and you can see U.S. equities is killing everybody else right now. International equities are struggling, developed markets especially. In fact, now lately they've turned up. You can see a little bit of a turn up here off of lows lately, but if you look at the major, let's see the 12 grid for the 12 biggest economies here. U.S. is dark green shading the green line, but you can see the developed markets have really struggled, right? They've turned back up right now, and they've got dark green shading in the green line in India, in Germany. This is an emerging market, but still a yellow line in the UK, still a yellow line in Italy, still light green shading in the yellow line in France. So they've rebounded, but not really enough to turn the tide. China just barely, light green shading and yellow line as well. Korea is still not recovering from what's going on over there. Brazil also not, still been down, dark pink shading and red line, for 3 months. Canada, again, the U.S. biggest trading partner, kind of matching the U.S. from that regard. So you can see it's really a U.S. story. It's been a U.S. story this entire time, and continues to be over the past few months or so. If you take a look at, let's see here, just what's going on here today, gold was the biggest mover today, up over 1%, even with a little bit of strength in the dollar. Commodities were also up, so you had a rising dollar, you had a rising commodities, and you had higher yields, and that's your three-headed monster, right? When you have those three things that put pressure on equities, especially emerging market equities. They really struggle today, but developed market equities also struggle with the strength in the dollar. Higher yields putting pressure on the Qs and IWM. This is the yields here now. Again, we just barely got two oversold clusters. We got dark pink shading and a red line. So we're still relatively bearish. The near-term line is up into bullish levels. Again, remember you got 2 days across above 60. So this was day one, or above 40 to get to above 80. This was day one, and the momentum line was only slightly above it that day. Definitely not in the reversal zone. So day two, we're not above 80 yet, so likely that this ends up failing here and not able to get further up above into the upper reversal zone. If you take a look at the moving averages, there we go. You can see we're at the 17-day. We're still kind of flirting with the 15,200, but we're at the 17-day and still holding resistance. So it'll be interesting to see what happens with yields, because this could very well be a reflection of what's going on from an inflation standpoint, as well as from what the Fed's expectations are for those rate cuts. If you take a look here at some charts here, let me pull this over here. You can see the odds of rate cuts are, there's a 16% chance that we'll get, or 84% chance that we'll get 2 cuts. That we'll get 2 cuts in the next 4 meetings. So the futures market is pricing in a pause, a cut, a pause, and a cut after getting this cut in December 18. But of course, the inflation readings, which we'll get here tomorrow, if you look at the inflation numbers, like right now, remember we had a little bit of a pop in the year-over-year inflation reading at the last inflation. Right here we went from in October, so at the November release of the October data, we went from 2.41 to 2.58%, or 2.6, I guess would be 2.4% to 2.6%. Well, if you look at the expectations here, so we're at 2.57 right now. The nowcast for tomorrow's inflation report is expected to be at 2.7. And then in the December reading, the December data that comes out in January before the January meeting, FOMC meeting, it'll be up to 2.81. So again, that's 3 consecutive monthly or year-over-year increases on a month-to-month basis since we bottomed out at 2.4%. So that's going to probably put some pressure on the Fed to not raise rates, which will probably keep yields from falling too much considerably lower. Because this is about where remember 4.375 is about where the Fed will be when they cut rates the next time. Again, you look at the 3-month. Sorry, let's go to the FOMC here. You look at the 3-month T-bill to kind of get an idea about where the Fed is currently and pricing in the next cut. 4.375 is the midpoint of the next cut's range. So the Fed has essentially priced it in, right? It's up a little bit here, but essentially you're right there at the 4.375 area. So the Fed's ready for that December cut. High probability of odds. I think it's at over 80%, 86%. So you have high probability. The bond market's there. You're going to get that cut. Whether you agree with it or not, whether you think the Fed should cut, it doesn't matter, right? The fact that the market has priced it in, that's really all that matters. And again, this kind of tells you the future path forward, and there's another cut there, but even that, just a couple weeks ago we were at 4.375. So if that inflation level starts to pick up again, then this will probably rise again, which will probably put a little bit of upward pressure on yields to where they bounce off of these lows and we turn higher and we start to get up towards these levels. Now we won't get very much higher than that because it will be restricted by the Fed funds rate. Unless inflation and the economic growth expectations really ramp up significantly to where we bust through where the Fed funds area is. And then now the Fed's got to raise rates. That's a situation that really nobody wants right now. But that will, your Feds, like the yields right now will be limited to the upside by that. It'll be limited to the downside as long as there's no expectation for the Fed to cut, or very little expectation for the Fed to cut in the short term. So I think we're probably going to be going sideways here on yields, which will probably be a good thing for equities. As you can see, just a little drop or a little increase in yields puts some pressure on there. What's really probably going to be the bigger factor is what's going to go on with the U.S. dollar, right? Is it going to go up higher? You can see, we've kind of had a little bit of a decline into bearish territory for the stochastics, to closer to zero on the MACD. If you look at the market forecast for the dollar, obviously we've been on a near-term decline, but you've had light pink shading. The intermediate line has come below market sentiment. It's out of bearish territory barely, but you're back to a pretty bullish near-term run. This is day 2, so again, how bullish it'll end up being, we'll see if we end up with a bullish peak or not. It doesn't look like it as of right now, but things can change. Can we get a new run up here? And remember, we're pretty we're relatively high as it is. We're not at that peak where we were at the end of 2022, at the end of the Fed rate cut cycle, but when you look at it in relation to historical, to where we've been in the past, we're higher than the last 20 years, aside from that end of the full brunt of that rate hike cycle that the Fed had in 2022. So the dollar's still pretty darn strong, and yet the market's been able to really have 2 really good bullish years despite that in 2023 and 2024. And so I think the dollar's rally, the dollar's upside is more limited as well. I don't think we'll have too much upside if I were to go all the way out to the full time frame we have for this data point. So we go out to 0102, you can see we were higher in the late 90s. And again, this is probably replicating a similar time frame of what we saw in 99 and 2000 and 2001, where the dollar strength is what popped that tech bubble. And, could it pop that tech bubble again? The tech bubble, we're not really in a tech bubble now, but we are in we're in a situation where there are relatively large sector weighting disparities among, especially gravitating towards the technology sector in particular, because that's where the 3 biggest companies that take up 20% of the S&P 500 reside. Could the dollar strength, could continued dollar strength put some pressure on that eventually? That very well could be the case by the time it's all said and done. Of course, commodities is another issue. And that's can give us an idea as to how strong or weak our expectations are, and we're still below the 200-day moving average, have been all year on commodities. Kind of surprising considering how bullish we've been. In fact, if you look at the last 2 years, we've been pretty bearish the last 2 years in commodities, and yet the stock market's been very strongly bullish. So it hasn't had its normal positive correlation, and we'll see if we get another turn higher in commodities. This big move in commodities, remember, commodities are the thing that moves last. So this big move on commodities, are we going to get another big move higher that ultimately precedes the actual bear market, which could definitely take some time, which would be a good thing because nobody wants to have a bear market next year. So if we can end up with another good, strong bullish move, probably not 20+%, but a strong bullish move, maybe commodities might be telling us that that's kind of where we're going if we were to get a new run, and that would obviously coincide with the new run in inflation as well. If we stay below the 200-day moving average, then as we know, equities are way too overbought considering where commodities are, and so there's way too much valuation out there if the economy is not supportive of that. And this would be a reflection of just how strong the economy is expected to be, because remember, a strong growing economy relies upon fuel, right? Energy, commodities to be able to fuel that expansion. Let's take a look at how the sectors performed here. So give me 1 second to pull up the sector comparison chart, and we'll pull up, you can see the 3 big ones are the big movers of the past 3 months, which is a good sign. That's what we want to see. In fact, here, let's do this first. Let's look at the 12 grid there's the 3 at the top. Those are our 3 biggest or movers that we want. And look at that, dark green shading and a green line. But look at everything else: materials, energy, real estate, utilities, healthcare, dark pink shading and red lines or a yellow line. We got a bull tag on industrials. We got light pink shading on financials. We got light pink shading on staples. This does not look so good. This looks great. This does not look so good. And then when you look at like technology, that doesn't look so good, right? That is not the kind of move that we wanted to see today in the technology sector. If we take a look at its chart, again, it's not too bad yet. One day doesn't make a trend, but you can see we are sitting right on the 17-day. We are back below its moving averages. When you look at the moving averages, we're still below the 200-day, which is not a good sign because it's a ratio that's strongly correlated with risk appetite. But we're back below all the 8, 17, 30, back below the 50, still below the 200. You can see how bearish, all these indicators are peaking. It appears like they're peaking from what would be bearish highs too, because they're definitely not bullish highs. So that's, hopefully this is one day, but you can see the breadth is looking poor. If you look at the number of stocks below the 50-day moving average, we're below the average, the 200, and we're well below 300 now. If you look at the number of stocks above their 200-day average, same thing, well below the average. Looking at the new highs and new lows index, you can see we're below the moving average there too, and now below 100. So that's not a good sign. You can see like we are really struggling. The new highs has dropped down considerably today on the New York Stock Exchange by itself. Big drop down in the new highs. Still, we don't have, the nice thing is the next stage would be a big increase in the new lows, and we don't have that yet, fortunately. We're not to that point yet. When you look at the, let's see here, this would be, no, not the percent, the breadth thrust. So this is the number of advancers we have relative to total issues, below the 50% mark, well below its average. And you can see even the McClellan oscillator. When you look at the McClellan oscillator here, and you can, just looking at this chart, you can kind of tell that we are in a low breadth environment, and you see that too as the McClellan oscillator has gone negative. All right, it's not below minus 35 yet, but it's gone negative, and look at that, we are now below 500. So things are changing. The money flow over the past few days has been weak after peaking at extreme highs on Friday, a very extreme high. Now we are back below 80, so we're on the drop, still at bullish level, so we're still okay, but you wonder if we had just had our parabolic peak, so to speak, there from a breadth standpoint, and now with breadth deteriorating, that typically leads to softness in the markets. All right, that brings us to our trade of the day in the technology sector, and it's on Oracle. Let's actually look at the market forecast chart for Oracle. You saw that it really dropped today after its earnings, producing a bull tag, right, dropping about over 6 2/3%, well below the moving average, down about 3 1/3% below the moving average. The intermediate line that had dropped below market sentiment already and produced that bull tag here a week ago, but we had a strong near-term rally going into earnings that brought the near-term line up above its intermediate. Well, now today it's back down below it. Not too strong bearish levels, but this is day one with the near-term line dropping below 60, and we'll see if it drops any more below that. Considering the momentum line is below the near-term line, but it's not oversold, so we'll see how much further it drops. But your intermediate line appears to have peaked here. This would not be a very good sign. It's already below market sentiments. It's well below the 80th percentile. So it would not be, we're more below the moving average than we were on this last two bull tags. So it doesn't guarantee that this bull tag won't bounce. Because remember, bull tags, you either bounce with a good strong run or you start an intermediate decline. So it doesn't guarantee that we won't bounce, but it increases the odds that it won't, and increases the odds that if it doesn't bounce, that means we're starting an intermediate decline here, potentially. If you look at the weekly chart for Oracle, you can see big transition candle with a red arrow, which means below the 10-week moving average. Obviously, it's corresponding to a pretty bearish candle itself. Not what we want to see, right, in terms of bullishness. But it is what you want to see if you want to be bearish, right? So we'll take a look at that. Obviously, we have 3 red arrows. We don't have a red line yet, but we have 3 red arrows with a lot of post-earnings volume. Not surprising to see all that volume there. When you take a look at the 2-line version of this chart, we have broken the 50-day average, and there's a big gap down to the 200 with a little bit of a volume node here, but not a whole lot of volume below this low point. So once we cross below the Halloween low point, if we cross below it, then there's not a whole lot of support down to the 200-day moving average. Typically, pullbacks start when you break the 50 and you work your way down to the 200. So that's going on right now. If you take a look at let's see here. If you take a look at the DMI, let's take a look at some of these other oscillators here. Here we go. The negative indicator popping up above the 30 level, right? And above the positive indicator, but the positive indicator at least is not below 20 yet. But part of the reason is the ADX is still above 25. So you tend to get more volatile moves in your ADX to the upside and the downside when your ADX is so high. When you look at the RSI and the CCI, big drop there, almost below minus 200, was below minus 200 at the lows of the day today. And you can see we were actually below 40 as well, and we ended up being only below 50, but lower than where we were on the Halloween low point on the RSI. When you look at the Ichimoku cloud, we are still above the cloud, but whatever trend we are trying to regain is gone again. And you can see the rate of change is only a couple of days away from being negative, clearly below the blue line there. Looking at the Bollinger Bands and the Keltner channels, we were below the lower band for most of the day. We ended up finishing slightly above the upper band and slightly above the Keltner channel after also being below that for most of the day. But the momentum has clearly shifted to the downside. The bands themselves coming off of a low level are starting to expand, and you would expect will expand out side of the Keltner channels as you'll get some negative momentum. So we may just be starting some negative momentum. So what I decided to do here was to go out to January, that's 38 days out, and do a long put vertical spread going out to that low 20s delta, now about the mid 20s. Selling that contract, buying the 175. It gives a little bit of wiggle room, but you can see in about a 2 to 1, well, actually about a 1.5 to 1 reward to risk ratio, which is actually a pretty low reward to risk ratio, which means there's a pretty decent probability from the options market standpoint that we will get to that 170 level, which is where the strike is, that short strike. So 170 would be right. Well, today's low point was 171, so pretty good chance that we could get down to that if we were to retest today's low. This is what it looks like here on this chart. It would be kind of like a dead cat bounce. We had a little push at the very end of the day, and we'll see if that pushes up through today's high and finishes filling in this gap, or is it a dead cat bounce? And that's kind of what we're trading this off of, is the fact that we are trading the dead cat bounce on this trade. And that's our trade for today. All right, well, that does it for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember, subscribe to our YouTube channel, hit that thumbs up icon, comment on the video, join us at MarketScholars.com for free, follow and like us on Twitter and Facebook as well. Have a great rest of your Tuesday night, everybody, and we'll see you all tomorrow.